On today's Hot Sheet, I'm discussing housing inventory for the past week, how mortgage rates could react to the action in Iran, and new home price record has been set. Today is Monday, June 23, 2025. I am Byron Lazine, and the Hot Sheet starts now. All right, live from Connecticut. Let's get into the hot sheet here for this week. A whole new world we're living in after the weekend. We'll discuss it. We'll get into it. I've already been asked the question a few times. I was on the golf course yesterday, hitting bombs, not dropping bombs. And I was asked a few times, hey, what do you think is going to go? How's this going to impact? Obviously, the developments Saturday night have changed the global landscape. And what will be the impact? We talk about black swan events in real estate. Hey, it's going to be the labor market that brings rates down or some type of black swan event. You know, is this that? Is this a black swan event? How are the markets reacting? You know, we talk about big, 100-year pandemics. That's a black swan event. A great financial crisis, a mortgage crisis back in 2007. Black swan event for sure. Okay. 9/11, that huge black swan event for the financial markets. Is this now we're going to get into it. What's it going to mean here locally for the housing market? But as we kick off each and every single week, let's first take a look at inventory. We've been tracking it now for really years as we came into higher interest rate environment starting April 2022 through today. What's going to happen with inventory? Remember the spring market of 22, inventory hit an all-time bottom level there. And we're looking for inventory to get back to healthier levels. Okay, so we saw a big jump up last week after kind of, a smaller increase the week before. Altos Research has us at a 3,000 plus increase for the last week. So starting to flatten the trend line once again here on single family inventory, for sale inventory across the country. That would be more of an expectation if we're following 2019. If we're following a more normal year, 2019 levels, then you would expect over the next couple months, this summer, active inventory to basically flatten out. Okay, kind of at that peak level for the year. That's what happened in 2019 anyways. Last year was quite different. Last year, the last week of June, we were at 634,000, but it took until October, later in October, to hit the peak at 739,000. So we still increased an additional 100,000 single-family homes from this point through about mid to late October last year. Last year at this time, we were 634,000 single-family active homes, or 828,000, with 31% more right now than last year. This past week, a slight 3,000 increase versus a 14,000 increase same week last year tells us that maybe we're not going to add another 100,000. If we were to add 100,000 on single-family active listings between now and October, as we did last year, then we're gonna be at we're gonna be obviously be into the lower 900,000s, and we're gonna be basically back to 2019 levels as it pertains to the macro across the country. Maybe not the case, 45 minutes north, 50 minutes north of me in Hartford, where there's 75% less inventory than pre-pandemic levels today, right? Maybe not the case in certain parts of Illinois or Ohio, right? It's going to be different in some of these Northeast, Midwest states that are still well behind. But these numbers are definitely being inflated from Florida and Texas and some of these Sun Belt states that essentially, in my opinion, overbuilt. I think we get wrapped up in the how many homes short to meet demand. We're 3 to 7 million homes short in this country. Really? Not in Southwest Florida, not in Texas, where they build, where the national home builders seemingly do annual masterminds together. They're all down there. That's where they're building. And, you're not building across the country. You're building in pockets of the country. So you're going to have, an outbalanced inventory in certain parts. On the macro, much healthier place, 200,000 more homes on the market than we were same time last year. That's single family homes. We're at lower levels of 2019, which is pretty crazy. Think about this, 2019 lower levels, we were at 820,000. I mean, I know this is kind of like before the spring market really takes shape, the earlier months of 2019, but that's where we're at right now. So we're lower levels of 2019 on active inventory. Quite an improvement. Who would have thought when we were in March of 2022 at 241,000 homes that we'd get here this quickly? All right, price cuts are one of the indicators that, hey, homes are, maybe we do have a chance of getting into the 900,000s on active inventory. Sellers are cutting at a higher rate than they have in recent memory. Price cut percentage right now is at 40%. The only time in the last 3.5 years that we got higher was the end of 2022. So late in the season, that's when you typically would see the highest price cuts in a 12-month period on a year, would be those holiday end of the year. Somebody trying to get a deal done before the end of the year. 2022 was the interest rate shock year. We saw this number spike from that point and into the end of the year, got as high as about 43%. We're only 3% away from the end of the year. I mean, you could have percent of properties with recent price reductions nearing 50% if we follow typical trend lines, where this number continues to go up through the end of the year. More sellers are cutting the price on their home if they want to sell right now. And it's not really due to a lack of demand. When you compare demand to last year, demand, it's relatively stable. And even you could argue that the future forward-looking demand is better than we were this time last year. We've had 20 straight weeks of positive year-over-year mortgage application data. We've had 11 positive readings, 9 on the weekly, negative, 3 flat. But when you go year-over-year, 20 straight weeks of positive data, that tells me that the future is going to be really strong in terms of demand. We get an interest rate to go down to 6%. Where are interest rates going now? We're going to talk about that in just a second. But interest rates going down to 6%, in that world, we're going to have a level up on transactions. Pending home sales for the week, 3,000 up, same versus the same week last year. So again, these aren't numbers like 2021, but these are showing signs of stability on demand. So total pending home sales for the year, 405,000, that annualized out, 405,000 right now. That's above where we were last year, above where we were the year before. It's 9,000 above last year's level. It's nothing, nothing crazy, but again, showing a stable environment on demand, yet price reductions are happening at a higher clip. Sellers have real big eyes. Okay. The last couple of years, what it was like for sellers dining at Michelin star restaurants and paying chain prices. Okay. Like, wow, we get all this for that. Like, big eyes for sellers. Homeowners in every neighborhood remember what their neighbor got a couple of years ago. How many cars were parked outside of the open house? Like, hey, are they having a barbecue? They didn't invite me. Speaking of barbecues, make sure you're signed up to BAM Barbecue. That'll be happening here on July 16th, the big virtual event of the year. It's our third big one. If you've come to any of the BAM virtual events, you know these are over the top. There's an entertainment value. BAMBBQ.live, totally free to sign up. These usually cap out on signups. I think we can't have over 5,000 or something like that. We hit that number basically every time in terms of the recurring viewers at one point or the other. So don't get locked out. We had that with a Sharon Anundam event that we did. Don't get locked out of this one. Ryan Serhant, Leo Pereira. We've got Scott Harris from experience.com. All three big major CEOs bringing the heat. BAMBBQ.live to get signed up for that. All right. So this summer, sellers are making tough decisions. There's a summer slowdown. Okay. I'm in Connecticut for the next few weeks, or next 6 or 7 weeks anyways. And for the first time in all year, Connecticut had bright sun on the weekends, and they had really hot weather. There's a heat wave going through the Northeast. Okay. Now, Northeast people are funny. They'll complain all winter how dreadful the weather is. They'll complain all spring that it rains every single weekend. And then a heat wave comes, and what do you think people from the Northeast do? They complain it's too hot. Okay, they can't find anything typically that they like or not to complain about. That's just the way it goes. I heard more complaints about the heat. I said, this is beautiful, guys. This is fantastic. But you know what the heat does? You know what the summer months does? It slows activity down. It slows decision-making down. All that heat seeps into the brain and just creates a slower decision maker. More vacations, more distractions, more high noons down on the shore. If you know what I'm talking about, if you watch Knowledge Brokers podcast, Tom Toole was down loving the shore weather this weekend. So you're going to have a slower decision maker, especially from the buy side. They make fast decisions in April and slower decisions throughout the summer. New listings increase this time of year, creating an imbalance on inventory and how many buyers are in the market. Now, new listings aren't hitting those peak levels that Logan Monashami is calling for over at Housing Wire. We only hit over 80,000 twice this year. That's the level he's looking for. For anybody that thinks this is a lot, just go back to the great financial crisis recovery then, 250,000 to 400,000 weekly new listings during that time period. We had 76,000 new listings. So that shows, and not being up over 80, that's kind of the landmark, shows, hey, there may be a lack of new listings slowing down this time of year. Usually you see it accelerating in the summer. Those late sellers, they feel like they missed the market, coming to the market. This little bit of a slowdown, it's usually the buyers that are slowing down this time of year. The sellers are also slowing down. This is just less listings than we expected. Might be a little bit of a weak summer market. I know the future forward data looks good on the mortgage application. Really need rates to go down, I guess, for some of that to take shape. So it's a week by week market. There's some signs that, hey, it could be a little bit slow here as we go through July and August. Rates would be the one thing that would help. And big question is the question I'm sure you had over the weekend. It's a question I had over the weekend. It's a question that we're going to dive in and see if there are any answers to it here today. How will mortgage rates react to the U.S. bombing of Iran late Saturday night? I woke up Sunday morning for my golf game, and I'm like, okay, here we go. The whole world's going to have commentary on this. All the world leaders are going to have thoughts on this, and people are, I'm sure, taking. I haven't gotten too much into it online with the drama kings and queens out there on X, but I'm sure there's a whole bunch of people taking political sides, a bunch of partisan hacks out there with their opinions. What we're focused on is, hey, what's going to happen to the economy? What's going to happen to mortgage rates? But in order to do that, let's just take a look at where rates have been the volatility of rates. Okay. Now, the last couple of years, before 25, when we look at 22, 23, 24, we've talked about volatility of the interest rates. Could have a half a point swing in a day. We haven't seen that this year. Okay. So this is the range, let's call this a volatility scale going all the way back to 2012 on interest rates. So the longer, if you're watching here on YouTube, by the way, if you're on YouTube and you can see your screen, thank you. If you're on YouTube, go ahead, hit subscribe, hit the notification bell. It's the best way to support everything we do at BAM. It's free, it's simple, it's painless. You hit a button with your index finger and you are subscribed. Would appreciate that. But if you can see the screen and you're not just listening to the replay, you see these purple lines. If you're listening, for example, 2022 spreads across the entire screen. Okay. 2025, my thumbprint is bigger than 2025, where 2022, it takes my whole hand to cover it. Okay. So 2022 was extremely volatile. The spread on the 30-year fixed went from 3.22%, okay, in 2022 as high as 7.08. The volatility in 2022 was extreme. It was wide. The spread this year has not been that volatile. We've been as low as 6.63, 6.6, give or take there. And we've been as high as 7.11. Not the gas station, Haley. Okay. Not the chain, not the mini mart chain. 7.11 on the mortgage rate. So 6.63 to about 7.11. Okay. And really, you've had most of it hanging around 7% or just under. It's been very stable. Using the word stable, it's been pretty much a tick under 7%, high sixes or just above 7%. Earlier in the year, it was just above 7%. And that's where we've been at. A lot more volatility in 24 than we've seen this year, a lot more volatility in 23, 22, extreme volatility. And really going back to 2012, besides 17, and 15, we haven't had this tight of interest rate dispersion since those years, since 17 and 15 to point to. Most years you have a wider margin of interest rates. Now, when you see a global event take shape, like we saw on Saturday with the U.S. now getting involved with what's going on in Iran, not just getting involved from a discussion standpoint with Israel, but getting involved from we're involved. Okay. The U.S. is now fully integrated into whatever happens, whether you agree with that or disagree with that. That's the reality of where we're at. Full involvement now to this point. How are the markets going to react? Is this black swan event? You're going to get asked the question, how are rates going to react? Well, interesting. So far, rates and the markets are just kind of showing no reaction or little reaction. Here's an article from CNBC, for example. Okay. Why global markets are brushing off U.S. strikes on Iran. Okay. So this is from today. This is from this morning, early AM hours. Market reactions after the U.S. strikes have been less aggressive, especially relative to just over a week ago. So when you had the initial airstrikes, and again, we didn't see much movement in the bond market, even with the Israel airstrikes, and we didn't see much of a movement on the 30-year fix. Let's be real on that. And now we're seeing less of a movement. Now, typically, volatility globally can create some volatility in the bond and the 30-year. You kind of usually to our advantage, meaning it goes down. Right? There's that flight to safety. on the 10-year, pushes the yield down, the 30-year follows. That's kind of what we're expecting when you have a global volatile moment. Not happening. Now, a couple things could be true. This article talks about that the investors are largely shrugging off the escalation. There are here's an interesting take, many strategists believing the conflict to be contained. And this is even creating a bullish environment for some risk assets, meaning, okay, the nuclear threat in Iran now contained, meaning there's not going to be a bigger problem. And there are some, I guess, investors looking at this as, here we go. There's a more predictable environment. I think there's an argument on the other side of that could say there's reactions coming. That this is, how this escalates from here. All remains to be seen. I mean, here's one of the decisions here that might be coming out of Iran: closure of. And this is factored into these articles, and it's factored into today's movements already. State media in Iran is voting to close the strait. This is the global oil trade strait. So there's 20 million barrels of oil and oil products that move through it each day. And you're already seeing, kind of a reaction, obviously, in the oil markets with that. But let's just take a look at where we're at on the stock markets. They're all up. Stocks are little change as traders monitor oil prices. Let's take a look at the bond markets. Okay, they're actually moving down. 10-year, anyways, is. And so interesting that you don't have a bigger reaction. There's not big movements here. These aren't. These aren't, reacting as if we're going into some type of 100-year pandemic or, another word I won't even use. Bloomberg says the decision by the U.S. to bomb 3 Iranian nuclear sites over the weekend has been greeted with remarkable equanimity. Equanimity, I would imagine, is the word. Remarkable nothingness is what I will use by financial markets. Are they too complacent? What could happen here today? So far today, to kick off, this Monday morning, there's not much movement. Okay, so mortgage rates, I would expect today, are going to be pretty much where they've been. The bond market's unusual reaction to geopolitical events has really followed the trend of the year, where there just hasn't been much volatility. Typically, geopolitical events in the Middle East tend to favor the bond market. Now, like I said, it kind of goes to our favor here. And the U.S. dollar, resulting in lower mortgage rates. Now, there has been a tick up on the U.S. dollar. Saw that this morning. But the trend that is being followed this whole year has been different. Okay, so we didn't see expected reactions in the bond market for the U.S. dollar on the June 13 attack, when the attacks began from Israel on Iran, and we're not seeing it now. And again, that CNBC article, kind of outlined the fact that there might be some investors saying, "Hey, contained and the nuclear threat contained is actually good for markets," and I guess business as usual. Again, a lot can play out. If you look at what type of retaliatory measures have been floated around online, there's a lot of things that could play out that change this. And so there you go. There's right now, the markets are not reacting. In this year, if this year continues to follow the current trend line on mortgage rates, there has been less volatility this year. You can go back 13 years than almost any other year in terms of volatility. Now, I get it. Rates are higher, sitting at a higher point than they've been for most of these years. but a lot less volatility. And so far, we're following that trend. So, not a black swan event like this is, I get it. Anytime bombs are flying and we're involved and all that, it's a big event. This isn't a global 100-year pandemic, and it's not a global great financial crisis. Those are classified as black swan events. So far to the markets, this just is not. All right, Redfin reports U.S. home prices, despite everything we've dealt with, they're hitting an all-time high. Despite inventory being at its highest level in over 5 years since pre-pandemic, despite prices going down in places like Austin or Southwest Florida. You look at the macro, you look at the U.S., the 4 weeks ending June 15, home prices were up 1% year over year, which sets a record 396,500 on the median U.S. Sale price. Now, sellers, they want more. Okay, the median sale price hit its all-time high. It's roughly 26 lower than the median asking price of 422,000 plus. That's a 6% discount over those weeks, and it's a reversal from 21 and 22 when the median sale price was typically much higher than the median list price. So total reversal there. Sellers get big eyes. They're sitting down at the dinner table and they're like, I want to pay Ruby Tuesday prices for Michelin star restaurants, and they're not getting it. That's why, hence the 40% price cuts. Okay, here's some indicators of home buyer demand and activity. Again, 30-year fixed under 7, and year-over-year change down from 7.04, so slightly down, but within the range, less volatility. Mortgage purchase applications up 14% over the year, 20 straight weeks. And Redfin's home buyer demand index is up 1%. The recent change is actually down 5% from a month earlier, seasonal, up 1% from a year ago, stable, steady. Touring activity up 36% from the start of the year as of June 16th. At this time last year was up 28% from the start of 24. So more tours being booked per Redfin. Google searches for home for sale up 10% from a month earlier, and unchanged from last year per Google Trends on that report. All right. Record sale price. It's June. We said this. April was the time to have the house listed. Now, historically, more listings come onto the market this year. It's why we're tracking that number in the summer. We want to get up over 80,000 on new listings. That should be the case in April, but sellers wait. They wait until when they think is the right time. They kind of just don't believe the data. April sellers always thank themselves because June is all-time pricing every year when you look at the 12-month calendar. And there's no surprise that this past June, we see a U.S. home price record high, never seen before, according to Redfin. May not be the case for your particular area if you're in the Sun Belt or something like that, but we're talking about the macro here, and that's the reality of where we're at. And in any given market, you're going to get a higher price in June, reflective of a true spring competitive market. As mentioned, 10-year down, just a tick, not extreme down, okay? The markets do not believe what we're seeing in the Middle East is classified as a black swan event based on the reactions so far. Over the last month, this is the low point. Take that. We'll take that. 3 months, we're kind of trending, I would say, more towards the middle range of where we've been. And we're at 4.332 on the 10-year, 30-year fixed rate. Ended the week last week at 6.86. So comfortably below the 7% level. I've got no expectations that today, as we kick off, a new week of tracking the 30-year fix, that this, moves up. Probably going to stay pretty much where it's been. The weekly came in at 6.81, so comfortably below 7, still pretty far distance from 6%, where we know the market would really open up and transactions would increase. Quick update on CME group. I know we're a long time away. Last week was Fed week. We're 37 days away from the next Fed meeting. They're just pumping a 83+% chance that there'll be no change, and there's a 16.5% change that they will ease the rate, and that's kind of the highest I've seen in some time. Very early, but that's where we're at on that. Where you should be at if you're in the Arizona market, certainly West Coast. It's the only in-person event we're doing. You can come from anywhere, by the way. I know some that have bought tickets are certainly flying in, but this is an easy one. If you're within driving distance, this one makes a lot of sense. It's the only in-person BAM event of the year. BAM Camp, September 24th, Scottsdale, Arizona. The only in-person one of the year. We're gearing up for BAM Mania. It'll be in Q1 of 26. Kind of changing the timeline on that a little bit. When we announce that, we'll have more on it. But September 24th, Scottsdale, Arizona, BAM Camp, bamcamp.live. This is the only in-person event of the year. Do not want to miss this one. There is limited VIP seats left. Not many of those. There is, I guess, maybe a little less than half of the mid-tier pricing. And then we still have main event pricing as well. Myself, Eric Simon, Luke from Reminder Media, Amy Stockberger, George Lawton, one of the biggest team leaders, top 10 teams in the country. He's going to be speaking. Tessa Bella, Tom Toole, Lisa Chinati, and Alyssa Kernut are the speakers up now. So go to bamcamp.live and get your tickets for that if you're interested. All right, there you go. There's your kickoff for the week. As always, I will drop they're already dropped there now. I will drop all of today's content from the hot sheet that you can use in your market right in the classroom under the hot sheet. And you've got new listings, inventory, all the slides that I used, all uploaded for you, as well as my notes for the show. Ton of stuff packed into just today's hot sheet classroom on school.com/BAMX for you to join the community there. All right. Have a great day. We'll see you guys back here tomorrow, 9:30 on the East, 6:30 on the West. You know the deal in between. Until then, toodaloo.